Hey, Ren, I was thinking, do you own any of the massive companies in the US?
Nah, mate, none of them.
Yeah. Why is that?
Too expensive. I mean, Berkshire Hathaway goes for like $290,000 a share. Amazon is like $1,500 for one share. Hell, I can't even afford Netflix at $300 a share.
Yeah, well, instead of waiting around for a pay rise, there's no need for that anymore because our friends over at Stake, they've solved this problem for you.
Really? Tell me more.
So Stake is the simplest way to trade US shares. It's a new Australian company that's just started up, and they give you access to over 3,000 stocks and ETFs over in the US, and they offer you $0 brokerage. You can also buy partial shares, meaning, Ren, that you can finally buy $100 worth of Amazon if you really want to. And you know what the best part is?
What's the best part?
Now we've teamed up with Stake over here at Equity Mates. That's you and me, Ren.
Yeah.
And we're giving our listeners the ability to sign up with Stake and get $25 in their account to get them started. So if they head to equitymates.com/stake, STAKE, sign up and fund their account, Stake's going to swing them $25 into their trading account to get them on their way. So that's free brokerage, the ability to buy partial shares, so you don't have to spend $1,500 on an Amazon share. You can buy $100 worth if you really wanted to, and $25 to get you going. Mate, you're almost halfway there to a Berkshire Hathaway.
Berkshire Hathaway. Mate, with that free $25, I could get 0.01% of a Berkshire share for free.
I mean, it's a win-win situation, really.
You know what? I reckon if I held that 0.01% of a Berkshire share for like 80 years, I'd be set for life. I'd retire in luxury.
Well, get started.
Yeah, I'm going to right now.
equitymates.com/stake.
Stake, STAKE.
Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. Great to be back with you.
As always, how's the week been?
It's been good. It's been good. We got a good interview today, which I think, I learnt a lot from, so I'm hoping our listeners learn a lot from it as well.
Yeah, same. I found it very interesting. It was good to go back to talking about the simple things in investing and financial management. And with our guest today, that's certainly what we did. We talked about the basics of savings and a lot of tools and techniques that are out in the world at the moment that can really accelerate your savings plans, so that if it's a house that you're saving for or your first stock or whatever it is, then we talk about all the tools and techniques, as I said, that you can get stuck into. So yeah, I definitely learned some stuff. It was good.
Nice
Enjoyed it,
one.
Ren.
Yeah. We should say who it is. So
Yeah,
it was,
take it away.
It was Graham Cooke was his name, or is his name. He probably hasn't changed it since the interview. Graham Cooke is his name. He is the Insights Manager at finder.com.au. For people who don't know what Finder is, it's a comparison website that lets you compare everything from different insurance policies and different credit cards all the way to different crypto asset. It's a comparison website where you can compare anything really, and try and get the best deal. So we thought, who better to speak to about getting the most out of your savings and your investments?
Yeah. So get stuck in.
Yeah, enjoy. Now, before we go, one last plug for Thought Starters. If you haven't signed up, make sure you do. Best way to start your week, 5 interesting articles in your inbox every Monday morning.
Head on over to our website and sign up to Thought Starters. As Ren said, email every Monday that we cover the basics and a whole bunch of information to save you from doing it yourself. So, enjoy Graham.
Equity Mates.
All right, well, we're here with Graham, who is the Insights Manager from finder.com.au. Welcome to the show, Graham.
G'day, guys. How you doing?
Very well, very well. So just to kick things off for our listeners, are you able to give us a bit of a rundown as to what does finder.com.au do, and what is your role as an insights manager?
So Finder basically is a financial comparison site. There's a few of them on the market, but we try to compare more things than anybody else. That's the aim, to compare the site that compares virtually everything. So we cover stuff like home loans, credit cards, insurance. We've recently started covering crypto to quite a deep depth, but also non kind of traditional stuff for comparison sites like broadband packages, mobile phone packages, and travel as well. So we kind of have a big publishing team who are constantly producing content and guides on these topics, but we compare kind of across the market and all those as well. I'm the insights manager. My role within Finder is kind of like research, really. I run a little research team, and we spend a lot of time mining data sources, so information from the Reserve Bank of Australia, information from the ABS, and also information that we have internally, because we monitor the whole credit card market, the whole home loan market, and looking at those sources, trying to find trends, trying to find stories of public interest, and then get those in the media with Finder, people talking about those topics. So that's kind of what I do.
So we'll get into some of your insights, and we'll talk about some ways our listeners can benefit from your insights in a little bit. But to kick us off, focusing on you and your personal sort of investing journey, how did you get interested in markets and finance and investing? And do you have any personal, investing philosophy or any investing strategy that you follow?
Yes, I'm not the biggest investor, to be honest. I'm not kind of like I'm focusing on investing in property in Australia at the moment. So trying to build up a deposit, but not the biggest kind of investor in traditional financial markets. More focused on trying to maximize savings as much as possible, even though that's a lot of other areas of what Finder covers.
Well, that's something that we have discussed in the show sort of way back when we first started, was forming good habits for savings. Because obviously it's critical to building up capital to begin investing. You can't obviously start with nothing and then just hope to have a house. So does Finder offer any resources for beginner investors or those looking to begin saving for a house, and sort of what sort of resources are they?
So guides is kind of the main resource that we produce, covering a huge range of financial topics. But from the investment angle, we produce some share trading guides and list a bunch of different share trading platforms on the site. Also, crypto investment is something we've gotten into quite massively. That's hugely taken off recently. So there's a lot of different crypto guides. I'm actually working on one myself, looking at crypto mining and the energy costs in that, and whether that's kind of a viable thing to be looking at doing in Australia. Spoiler alert that it's not, but in some other countries. But we're just kind of constantly exploring all these different areas. And we've also got some superannuation investment guides on the site as well, which may be useful for your listeners. Yeah,
very much so. Do you charge for these? Because it sounds like, there's a lot of information there, and something that, I'd be interested in definitely having a look at the crypto, for example, but a lot of these places where you to go and find sort of reports on this sort of stuff charge. Do you charge anything for these resources?
No, all of this is completely free. It's all open to the public. All of our content is public facing. We use it to drive traffic to the site, and then the platform channels people through to other products. But all the actual content on the site is completely free.
Oh, nice.
So, Graham, the reason we got you on today is we want to benefit from some of your insights and some of the work you've been doing at Finder. And so we want to talk about some ways that we can grow our savings and some sort of new investment technology and new investment opportunities that are out there. So Let's start with savings. You said before that you're saving for a house, and that's your focus at the moment. So very high level, what are the main things that our listeners need to keep in mind when they're thinking about saving, for a deposit or for that first investment? And what are the big influences on how well they can save?
So the biggest influencer on how much you can save in Australia at the moment is, as you probably know, the RBA cash rate. Now, this is the rate that determines the interest amount that you will make in a savings account in Australia. And it usually goes up and down. There's a decision on the first Tuesday of every month as to how the cash rate's going to move. And all of the savings accounts and all the home loan interest rates will move as soon as the cash rate moves. we've seen an unnaturally long period. It's been over a year and a half now of stagnation in the cash rate. So it's sat at 1.5%. It hasn't moved for over a year and a half. I think it's actually the longest period that it hasn't moved as long as records have been kept, and we just passed that this month. So it is a hugely low interest world at the moment, 1.5%. We haven't seen a stretch of interest that's this low in a long time. So for those who are trying to save through traditional methods, the options are kind of few and far between. You'll see a lot of savings accounts with the big four banks, which are offering a kind of semi-attractive rate up front, 2.5%, maybe 3% in some places, which is actually just an introductory rate for the first 3 or 4 months of having the account, and then it will drop. We're seeing with many banks now that the base rate that those accounts then drop to is sometimes even below 1%. I'm seeing kind of 0.8% on the market. So it's definitely a difficult kind of environment for savers at the moment. But there are other savings accounts you can focus on to kind of to increase what you can earn on your savings.
So 0.8%, I mean, that's virtually nothing. And if you've got a large amount of money sitting in there, or you're consistently putting money in there, the markets are going up at a probably faster rate than 0.8%. So what are some, if you're not ready to put your money in the market and you're not ready to put it in another asset, and you do want to just put it into a bank account, are there any ways that, other than these introductory offers that you sort of speak of, that you can try and maximize your return from interest?
Yeah, absolutely. You need to look at accounts which will give you a bonus interest rate like you will get with those accounts I was talking about before. But rather than giving that for a temporary period of time, you'll get that interest rate as long as you fulfill certain conditions ongoing. So some of the big four banks have accounts like this. As long as you open a savings account, deposit money continuously and don't make any withdrawals, that's the key bit, because you can't then access your savings. You can access slightly better savings interest rates. Westpac is 2.3%. Combank is around kind of 1.7 to 2.3. ANZ is 1.7. So they're kind of better rates than nothing, but it does kind of lock in your savings. But the best flexible savings accounts on the market right now are actually from the online banks. So two of the kind of best ones here are ING and ME, where you can get, it's 2.8% with ING and 2.85 with ME ongoing, so continuously on your savings, as long as you fulfill certain conditions. So usually that means making a purchase with a debit card with an associated current account every month or every week, or getting your wages paid into your account, basically doing your everyday banking with those banks. But once you do that, you can access ongoing rates of 2.8 and 2.85. Now, comparing that to the big four, we were talking about the 0.8, you commented that it was very low. If you're investing from a 20K base, $100 a month, not a lot of money, the difference over 3 years you would make between that low rate and the ING is 2K profit rather than 560. So it does make a big difference overall.
Yeah.
Having said that, the ASX averaged 5.5% growth over the last 10 years. So, maybe slightly risk averse, you might do better too.
So, Graham, you really seem to know your stuff. You know all the different interest rates that are out there and all the different banks are offering. Does Finder offer a comparison tool or something like that where our listeners can go on and see the different savings rates they could get?
Yeah, you can go on to Finder. You can compare all bank account saving rates in the country, everything, and you can look up kind of write-ups on each of them and reviews on each of them, and kind of see what is most suitable to you. And you can also see kind of alternatives if you wanted to get more out of your savings than that 2.8% or 2.85 from ME. You can look at alternative options that are coming onto the market now, like one of which, for example, is peer-to-peer lending. So rather than leaving your money in a bank and letting it accumulate, you actually lend it out to people who are looking to borrow money, and you'll get a bigger interest rate on that, even though it's slightly higher risk than you will with a bank. So RateSetter, for example, at the moment, are reporting 7.8% return on their funds if you invest with them over 3 years, which would produce 5K on your 20K investment rather than 2. So there are alternative options out there if you want slightly more risk than a savings account, but not as much as actually investing in shares.
So is there more risk with lending to, directly to peers? Because I guess when a bank takes your deposit, they then go lend that money out. So in effect, It's a similar thing. You're just cutting out the middleman being a bank. But does that add more risk to the equation?
Yeah, more risk, more return as the way it goes. So definitely there is more risk involved. I've spoken to people who invested with RateSetter and alternatives, and actually haven't spoken to anybody who had any issue getting a return at the end of it. But there is a certain level of risk involved, so it's definitely worth doing your research and not investing, all of what you've saved. It may be worth a dabble on the side initially, anyway, and see how you go.
So you would recommend splitting across these sort of alternatives to maximize your return, essentially?
Yeah, diversify. So I've got one of the high-end savings accounts myself, but I've also got a little bit of a RateSetter account. So it's kind of something that's interesting to experiment in separately. But yeah, I wouldn't be putting all your funds in there either.
So you say there you've got two sort of main ways to save, and it's good to talk to our listeners about methods of saving in terms of, you get your lump sum pay, and then it's good to have a consistent sort of strategy in place. Do you have a particular strategy in place, or know of a simple one that sort of works really well that would be simple to put into place for some of our listeners?
I think with saving, the thing is it's just to keep it regular. Often if you take a certain amount away from what you get paid every month, that is something you can afford to lose, and you set up a direct debit where that constantly gets transferred to a savings account, for example. As soon as your pay comes into your account, you'll find that your spending will kind of adjust to accommodate what you have left to spend, and over the course of 12 months, if you put it into a high-end savings account, that amount that you've transferred across will build up quicker than you could think. So it's really setting up that direct debit so it happens automatically. You don't have to think about it. And then you'll just kind of automatically quicker than you realize.
Out of sight, out of mind.
Yeah, exactly.
So Graham, we started with talking about the RBA, and I want to bring it back to the RBA because, as you said, the world has been in a very low interest rate environment. In Japan, we've even had negative interest rates. There's a lot of talk that the world is sort of coming out of that. We're getting a little bit of inflation back in the system, and there's talk that interest rates will start to rise again. What should people do in a rising interest rate environment to maximize their savings?
It depends on whether you're looking at home loans or savings. What's going to happen to the cash rate is going to be interesting depending on kind of who you listen to in terms of rising rates. So we survey leading economists every month. We have 30 or 40 that take part in a panel that we use to research. And we've been doing it for years now. And they've all, for the last year or so, constantly been saying that the next cash rate in Australia is going to be up. But the time when they say that upwards cash rate movement is going to happen keeps moving forward more and more and more. I mean, a year ago it was around now, or even before now, they were saying the next movement was going to happen. But now most of the economists are saying probably no cash rate movements for the rest of this year. And then the predictions for next year are evenly spread. But I'm seeing some economists saying maybe nothing even till kind of Q3 or Q4 next year. So we might not be seeing much action in Australia over the next kind of 12 months or so, but we are seeing some in the US. So the Fed Reserve has increased rates, and it looks like they will do again. And normally in Australia, anyone with a mortgage, the bank will increase the interest rate in the mortgage once the RBA increases the interest rate here. But we've seen some banks increase interest rates, even though the RBA hasn't. This is something we call out of cycle rate hikes, and they're rare enough. We got a couple kind of on and off over the last couple of years, but the reason cited by the online banks was increased cost in funding for them because the Fed increased rates in the US. So we may actually see the Fed rate increase affect people in Australia, even if the RBA doesn't increase rates, if other banks also feel the burn of that increased cost of funding and then have to pass it on to mortgage holders. So that's the kind of most direct way it could affect people, even if the cash rate here doesn't move.
Yeah, wow. So it's a tough environment if you want to be in cash at the moment. Yeah, right. So that, I guess, leads us on to some alternative ways that you can make use of any spare money that you've got. And there's a lot of sort of platforms out there and alternative sort of options and new apps that are starting to appear on the market, particularly targeted towards millennials. Are you doing any insights and providing information for, say, like our listeners on what's coming on the market? And can you give a few examples on what we can put our money into?
Yeah, we can go through a few. Actually, you mentioned millennials there. This is interesting, just related to a survey we did recently looking at people's kind of investment habits in Australia and whether people have invested funds. And it was about kind of only a quarter of people across Australia have ever invested funds in anything. But if you look at the percentage across generations, it actually goes down as you get closer to millennials. So baby boomers, 1/3 of them tend to have invested. But when you look at Gen Y, it's less than a quarter. So all of these new platforms we can talk about now in a minute are all aimed at getting that millennial audience who tend to have kind of high income and funds to spend, but aren't necessarily investing, who are very tech savvy, who do everything on their phones, who listen to podcasts like your podcast, kind of getting them involved with investing, and also trying to promote ways of alternative investing like 0% brokerage fees and stuff. So there's two kind of ones we can start off talking about, which are Robinhood and Whaley. These are $0 brokerage fee platforms. Robinhood is a US one that already exists and are launching in Australia. And they've got this kind of website, if you go to it in Australia, where there's this thing you can sign up for information as to when they're going to launch. And if you sign up, you get put on a waiting list, and they'll give access to people in order of when they sign up to the mailing list. But if you sign up, they'll immediately ask you to send the mailing list to friends. So I did an experiment in the office and sent it to some people in the team and got them to sign up. And just by getting 3 or 4 people to sign up, I got from, I think it was like 100,000 in the waiting list to 1,000th.
Oh, wow.
By sharing it just 2 or 3 people. So you can skip the queue. It does feel a bit like schemy, I suppose, that they're kind of getting all these people to sign up. But it's the same strategy they used in the US, and they got 500,000 people on board or something before it launched, and it was successful over there. They don't charge a brokerage fee. There's also Whaley, which is an Australian startup. If you go to Whaley's website and Robinhood's website beside each other, they look almost identical. Whaley have also got a thing where you can sign up. They're not launched here yet, but they'll have $0 brokerage, and they have a very similar looking app. But they've got only 1,000 people in total, or maybe 1,300 in their mailing list. So they're very much playing catch up. So both of these, $0 on trading. The way they do make money is by charging a percentage of what's in your account, though. So you don't get nothing for free in this world. Whaley charges 0.5% on your total account balance, and Robinhood has a kind of flexible fee depending on the funds that you have in your account and the buying power that you have in your account, going from 0.3 to 0.6. So these two are definitely kind of interesting options which enable you to invest on your phone, and they are cheaper than paying a certain percentage per trade. So they're definitely worth looking at, but they haven't launched yet. So it's very much watch this space, but maybe worth signing up for. And then the third one in this list, which is a kind of similar platform, but more directly aimed at giving people access to the US market, is Stake. This is another Australian startup, which is on your phone. This is currently operating, and you can buy and sell shares in the US with no brokerage fee. These guys make money not by charging a percentage of what's currently in your account, but they charge a 0.7% on the funds when you convert your Australian dollars to American dollars. So, say you transfer 100 grand across or 10 grand across or whatever, you get a percentage fee. Then you can then invest as much as you want and leave it in there for as long as you want. Once you take it out, if you convert your profits back to Australian dollars, you'll get charged that same fee again. So it's just kind of a different way of doing it, but still a lower cost platform than others on the market.
Now, we should have to declare our interest here that we've actually partnered with Stake to offer people who want to sign up $25 towards their first trade. So, everyone check that offer out. But we also should just declare that we've sort of, we've picked sides in this brokerage-free war that's going on. But I'm interested in sort of joining the dots between what you said about the demographics works that you and Finder have done when you surveyed different populations in Australia, and what we're seeing in terms of the new investing platforms. It seems that brokerage itself has been identified as a big issue and a big sticking point for people, given that Robinhood, Whaley, and Stake, all of their major selling points is brokerage-free transactions. So was that something that you found in your survey work, that brokerage was a big point of, resistance for people investing?
I wouldn't say it was brokerage fees particularly that were an issue. I think it was more knowledge. I mean, so of the sample size, about 25% have invested, but of the 75% of the Australian population who hadn't, most of those obviously didn't invest because they said they didn't have any funds spare to invest. So that's fair enough. But the biggest group of those that were left said they didn't invest because they didn't know how. So it's just an accessibility issue more than anything. And what these apps are doing is placing the tools to invest in the palm of your hand. I mean, everybody has a smartphone now. And so opening up that market and presenting an ease of access to people who haven't had a way to invest before.
I have been thinking about this for a while, and this is something that I haven't even discussed with you, Ren. I'd probably like both of your opinions on this, but I definitely agree with that in that these apps are making it much more accessible to buy, but in doing so as well, they, some of them make it so easy to just buy, say, for example, the company that be it Apple or Facebook, with the click of a button, that there's no actual investing research or fundamental or any idea about what you're actually doing that goes into that purchase. And so, I mean, long term, the ramifications of doing that could be quite dangerous. So I'm just wondering if, yes, they've made it easy, but is it too easy,
That's an interesting one. I mean, I don't know which of us you wanted to answer, but that's an interesting one, giving people access without them needing necessarily to kind of build up the knowledge. For me, it kind of links into Australia's, the best way to phrase this, Australia's ease of taking on gambling. So gambling's a really big thing in Australia. Pokies in every single pub is not something that is normal in kind of most of the rest of the world. And when you have access to the share markets and you can invest and you can win, you can lose, but you don't have to have much knowledge. It does sometimes feel a little bit like gambling, so it is definitely essential for people to do the research on this and not just jump kind of headfirst in.
Yeah, agreed.
Yeah, it's an interesting one because so when you think about like the users that would use, Stake, Whaley or Robinhood, there's going to be a subset of users that would otherwise have used a more traditional investing platform but are attracted to these platforms for whatever the reason. No brokerage, ease of use, different information. And so for those people that, understand the markets and all of that and are just choosing this platform over another platform, then I don't think there's any risk about making it as easy as possible. But then there's obviously the other subset that, but for these platforms, wouldn't be investing in the first place. And I understand the concern, but I think, given the stuff that you found with your research, Graham, where so much of the population hasn't been exposed to the market in any meaningful way outside of super, I guess. And given that markets are, the greatest long-term wealth creator that I guess we've ever seen in human history, but definitely in our lifetime, if you can find a way to compound your money 9-10% a year every year outside of markets over a long period of time, well done, I guess. So, in the sense that it gets more people into the market, I think that's a good thing. And definitely there's downside risk. There's risk that, people are only investing in the FANG stocks and stuff like that. And there's risk that people aren't doing their research properly. But I think exposing people to markets is worth it, that risk.
So, Graham, just quickly, with the reason for men and women not being in the markets and investing, is the reason generally the same between both male and female, or does it differ slightly?
There's a slight difference where it becomes interesting and where it increases if you look at the specific reasons that men and women cite for not investing. And the main one we found across the board was people saying they don't invest because they don't know how. So it's really a knowledge issue. But this was very different with men and women. Only 7% of men said that they don't invest because they don't know how, or that they have a lack of knowledge, whereas that was 16% for women. So there definitely is a lack of knowledge there. But also, it's interesting looking at people who said they don't invest because they don't have funds spare to invest. That's also much higher for women. So only 1 in 3 men said that they can't afford to invest, basically. But that was a lot higher. That was 45% for women. So there's definitely potentially wage gap issues there that are causing a blockage to investment potential.
It's interesting. It seems just to be like a financial literacy thing, because at the end of the day, like that you don't have money to spare to invest. Like, of course, everyone has different circumstances, but even if it means putting away $5 a week into, and we'll talk about micro investing a bit later, but you know, it seems like an educational piece there for both sides, male and female, is the main contributor.
Yeah, definitely. And that's one area where these kind of new apps and platforms can open up opportunities for people that weren't there before with small funds. One of the ones is Acorns, for example, which has recently renamed themselves as Raiz. I don't know, it's a slightly questionable.
I know, very controversial.
I mean, you still use Acorns for a colder day, but I don't know where Raiz is coming from. But those guys are very much focused on that kind of demographic who feel like that. So maybe those 45% of women and 33% of men who feel that they don't have the funds to invest. Raiz focus on allowing you to micro invest, so to invest essentially the spare change from your transactions, and they take that on board, and they then invest that in kind of a spread low risk portfolio, and you can just watch your funds grow over time. At least that's the idea. They reckon with just $30 a month of investment, you could build that up with a conservative portfolio to $1,200 in 3 years. Now, on my reckoning, that's about a 7% return, so it's double what you'll get with a high effort savings account from any of the online banks. So it definitely is worth looking at, but it's slightly less than you would get if you put your money in peer-to-peer lending. So it's definitely worth considering all the multiple options, but it's a very easy way to kind of save a little bit and watch it build. Is
that 7% including their fees?
The fees they charge are $1.25 per month. So that was just a calculation on what the return would be based on what they said the return would be for $1,200. Right. I don't know whether that actually includes fees offhand, to be honest.
Right. Because one of the criticisms that Acorns often get is that $1.25 per month, and say you're only putting in $10 a month, as a percentage, the fees are quite high. But
that's true. If you're only investing that $30 a month, true, that will eat that up quite quickly.
Yeah, but from an educational sort of piece, I think it's a great app. I also wanted to just quickly go back on the Robinhood, Whaley, and Stake. Do they all, Robinhood and Whaley, charge an exchange rate, or is it just Stake? I just want to sort of clarify that for the listeners, because it's quite an important thing where you need to add up all the fees, and it might all seem fine and dandy to have free brokerage on all these things, but you need to look behind and actually understand the smaller parts.
As far as the information on their websites seems to say at the moment, it's just Stake that charge it that way. They charge it based on when you convert, whereas Whaley and Robinhood charge it by how much is actually in your account. So that's different two ways of doing it. But the amount of information that's available about Whaley and Robinhood is quite limited because they're still both in launch stage. So it kind of is a case of wait and see with those two. I mean, I wasn't able to see whether or not they're going to provide access to the ASX, for example, as well as Australian shares. So, and because they're both still in the process of acquiring licenses and such, there's not even a timeline as to when they're going to launch. So it'll all kind of become clearer in time, I think, with those two guys.
Right.
Yeah, so we've spoken about the three apps that offer free brokerage. We've just touched on micro investing with Acorns, well now Raiz. Mm-hmm. One other one that has sort of sprung up in Australia that is doing some interesting things is I guess you would call it like fractional property ownership, I guess. There's probably an easier way to say it, but yeah, the app BrickX. So can you tell us a little bit about that? And have you guys, do you have any thoughts on it, or have you done any research on it at Finder?
Yeah, I have to say I love this concept, but it gets incredibly complicated incredibly quickly. So this is BrickX. The idea being that it opens up the property market in Australia to people who can't afford to buy a whole house. I mean, if you're talking about the median property price in Sydney is north of $1 million at the moment, so that blocks a lot of people out. So the idea here is that they purchase a house and divide the house up into portions of a property which they call bricks. Each house divided up into 10,000 units essentially, and investors can buy those units. And then watch that investment value grow over time. You can sell the individual bricks later. You can also make rental income off those bricks, and there's a 1.75% transaction fee whenever you buy and sell. The problem is, because there's so much involved in forecasting how much you'd make from this, it's very, very complicated to actually look at what the returns would be. There's a very long piece on Business Insider that's looking at trying to forecast this, but it's really probably too deep to get into in a podcast. And to be honest, looking at the property prices in Sydney and Melbourne at the moment, they're stagnant / fluctuating, and they have been for a little while. Auction clearance rates are going down. So if you're going to divide up the return of investing in a property across 10,000 units, it's going to be a small enough return. Looking at the way property prices are going, you need to weigh up your options and see whether kind of investing in property is the best thing to do right now, and maybe wait and see what the market does.
Yeah, the really interesting thing for me with BrickX is, so like there are two ways you make money, as you were saying. The first one is rental income. So you buy a brick that's 1/10,000th of a property, and you get 1/10,000th of the rental income. But then you can also make a capital gain. So you can sell the brick back into the BrickX market. What interests me though is BrickX are setting the price. Like, they're not selling the property when you want to sell your one brick. They're telling you what the price is for that property, and then you're selling at that price. You have no sort of bargaining power, I guess. So that's an interesting sort of point of leverage, I guess, that the app has over you. That if they say, property prices are cooling, then you're a price taker in that sense.
What makes that interesting is the property price, as you say, is based on what they determined it is, which means it's based on some sort of valuation. So the increase in value is not based on what you would get if you actually sold your share in the property at that time. It's based on what the market valuation is. So yeah, as you say, it does give them leverage over you.
Yeah, it's something that I'm definitely going to look into just from an interest standpoint. I mean, this is something we could go into a bit later on, but I don't really understand the difference between it and, say, a REIT on the stock exchange. They both seem pretty similar in terms of the idea. But anyway, well, Graham, I think that will be a wrap for us. It's been great to have you on the show. It's really good to sit down and discuss the sort of basics and fundamentals of investing and growing your capital, because it's so important to do. And now it seems that, through places like Finder and the research that you're doing, it's becoming much more available to people like Alec and myself, the millennials, to find information and then make a decision on where's the best way to put our money. So, we did everything from the free brokerage through to micro investing and the RBA and the interest rate. So thanks for sharing your time with us. And for anyone that's interested, are you on Twitter or Facebook, or how can people get in contact with you for further information?
Yeah, I'm on Twitter at gcooke42. The 42 is Hitchhiker's Guide to the Galaxy reference. It's not gcooke42.
Answer to life, isn't it?
Insights blog at finder.com.au, so you can check out that there, and that covers various different consumer topics as well.
Yeah, I just want to reiterate that, at the start of the interview, we discussed all those fantastic resources that are available on Finder. So Alec and I will throw some links to those in our blog. And yeah, again, thanks for coming on the show. It was fantastic to get a bit of your insights into this sort of stuff.
Thanks, guys. It was a pleasure.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.